Good afternoon, everyone. This is Robert Rayburn here at Life Pro. It is August 21st of 2023. Hopefully everyone's staying dry out there here in San Diego. If forecasts are correct, because we do record this on Friday, San Diego is going through its first tropical storm since 1939. So what has proven to be a very interesting couple of years in the market continue to be a pretty interesting time period weather-wise here in San Diego as well, as this will be the first time in the summer months that we get over 2 inches of rain. So we'll see how accurate those forecasts are. Maybe it'll be completely sunny by the time that we roll out this recording. But other than that, we got a big week ahead of us. We got Jackson Hole and the Fed speaking and Jerome Powell heading up that speech on Friday. So we'll get a lot more color as it relates to the potential for more interest rate hikes into the fall. So I think the market's already been reading into that. 10-year yields breaking out. So we'll go through that in a little bit more detail. And then, of course, we got the NVIDIA earnings report that's going to come out this week. We don't own NVIDIA, but we know that it's a bellwether as it relates to technology and growth stocks in particular, which we have been fairly negative and pessimistic on. I think you've started to see the real sizable cracks in that market. So we're going to go through all of that this week. But the three big takeaways as we see it for over the past week is that the stock market pullback that we've all been experiencing is healthy. Now, there may be a little bit more downside in that. Right now, we're going to go through some of the stats where around 5 or 6% or so the market has pulled back. Now, fortunately, for our clients, we've been in energy and we've been in some of these other sectors that have been a little bit more insulated from that pullback, as it's largely been centered in growth stocks. That nevertheless, the weakness has been across the board. So whether it's been a sharp correction or a more shallow one, this seems to be fairly garden variety. But we'll go through the stats there here in a second. Interest rates are continuing to drive cash into value portions of the market and out of growth. We believe that'll continue. And then lastly, oil and copper are displaying remarkable strength through these China headlines, through the market pullback, through questions around growth. And we think it's largely has to do with the fact that the economy really is actually holding up pretty well. So as it relates to this stock market pullback of 5 or 6%, do we think there's a little bit more to it? Yeah, probably, because once you get through 5%, you tend to get closer to that 10% level. So again, completely normal. We've had 239 sell-offs of 5% plus since 1927. The median magnitude of these 5% plus sell-offs is around 8.23%. And we're going to through a chart here where we think that's actually largely what we're expecting this time around as well. And so when we think of the average magnitude of those 5% sell-offs, well, 14%. So in other words, when we're trying to account for even some of the more extreme sell-offs that may pull the stats a little bit over to the right, again, around 14% or so. Right now, we're about 5.26%. Again, we think this is probably in that 5 to 10% category. We were in an uptrend. We've had this pullback. But we think the more important aspect of this particular downtrend is the rotation out of growth and into value, which we'll go into more detail here. Here we can see the chart on the right. This is the S&P. We've been in this uptrend since stocks bottoms last October. So as you can see, rallies have been around it, whether it's about 17%, 11%, 20%. And the pullbacks, we've had 3 pullbacks so far. So the first pullback occurred late in 2020, or really kind of late 2022, early 2023. And that was around 8%. We then rallied 11%. We had another 9% pullback. And then we rallied about 20%. And now we're at about a 6% or so pullback, but all within this channel. So would not surprise us to get to this 4,200 level on the S&P 500 and then rally again. But this time we think the rally is not going to be centered around growth and technology. We think it's going to be rallying around these sectors that are actually holding in during this pullback, such as energy, such as material stocks, such as industrials. Those are those old economy areas that are more value oriented. We think those are going to be the new areas of leadership. And we think there's a secular bent to that. And we'll go through that chart that we've shown in the last couple of weeks But that's kind of where we're at right now in terms of our overall view. The other thing we do like to look at in terms of market pullbacks and corrections is what's not working and what's working. Because during market pullbacks, you get a little bit of clues around potential shifts in leadership, whether that's from a secular standpoint or a shorter term cyclical standpoint. You want to understand what's working and what's not working so that when the fever in the market breaks, we can then say, hey, these are these cyclical, economically sensitive areas of the market that held in pretty well. They're showing signs of durable leadership and market rotation. Let's start to add in more exposure to those areas. So what we can see here, since the market started to pull back, technology has been the worst performer, okay? Down 8%. Now, if you're really bullish on tech, you might say, hey, tech's had this huge run. And we would agree with you. That's a natural byproduct of having a big run, is the pullback might be a little bit deeper. That said, when you're in a secular bull market and you're in an area of enduring strength, those pullbacks actually do tend to be a little bit more shallow. So you'll get a really big ramp up and then a pullback into the breakout point before resuming that uptrend. Technology is the laggard amongst the sectors right now. And it's important because look what else is lagging: utilities, real estate, communication services, some of these areas that are actually a little bit more defensive in nature. So when you go through a market pullback, you would expect utilities to actually outperform, but it's not. And this suggests to us that interest rates are going higher because utilities are an interest rate sensitive sector. So the fact you have rates going up, energy outperforming, and industrial is actually in the top half in terms of relative performance during this downtrend, I think speaks to the fact that we're in this more economically sensitive environment where the economy is actually not that bad. And you're seeing it reflected in rates. So what's been driving it? So technology has been the big driver of the weakness, which we, of course, don't have any exposure in right now. And there's been other things, a lot of sell side shops capitulated and said there will be no bear market, no pullback, whatever. That happened in late July. So almost like the very last bears got into the market. Bank of Japan showing signs of raising rates. So that scared some people. All this news around China and the real estate sector and the commercial real estate sector collapsing, all that kind of stuff, the China bubble, that has all added to some angst in the market. Again, we're going to go through why the narrative around China appears to be a little bit different than what the price action is showing. So I think, again, we want to pay attention to price versus narrative and always give the benefit of the doubt to price. So what's working in this tape right now? So far, what's working, again, that doesn't mean what's worked so far is going to work in the future, but can give us some clues. What's working in this tape: energy, copper and metals, and industrials. Okay. What's not working in this pullback: technology, utilities, and staples. Okay. So the first two, utilities and staples, tend to be recession-proof areas. So if we were going into a recession, you would expect these two sectors, the utilities and staples, to be in this green column, but they're not. Technology, we think, is in a sort of a sector on its own. We think that's in a bubble. So we're actually not surprised that this particular sector is underperforming. And if you watched our updates for the last couple of months, you'll know we're very concerned about technology. We do think that's in the midst of a big bubble that might be unraveling here. Now, energy, copper, metals, and industrials, what do they have in common? What's the clue that the market's trying to tell us? Well, they're all very economically sensitive. Their earnings are driven by utilization rates, right? So they don't have a lot of pricing power. Their pricing is driven by the actual price of the commodity as it trades over an exchange, the futures market. So the fact that you're seeing the strength of the market coming from the most economically sensitive sectors, I think speaks to the fact that, hey, the economy might be more enduring and stronger than we all have in our heads, right? I think a lot of people are assuming that the economy is weakening and going into recession. Maybe the economy is a lot stronger than we expect, right? And when we look at the Fed GDP Now forecast, so this takes real-time data and says, well, what do we expect the economy to grow in Q3, So from the months of July, August, and September. So when September, the books in September close on Q3, what do we expect that GDP number to be at? Right now, that number is tracking at 6%. That's enormous. I mean, that's ahead of China. That's ahead of Japan. That's a leading GDP number across the industrialized world. So the economy is actually showing quite incredible strength, and you're seeing it in the inflation numbers, you're seeing it in the PMI numbers, the industrial numbers, you're seeing it across the board. The other thing that we want to point people toward is the fact that now almost no one on Wall Street is concerned about inflation. Really? Oil's up 25% since March. Gasoline prices are up 24%. Natural gas up 30%. Copper's up 5%. All of these prime things that go into other things that we build and purchase and use are going up quite dramatically in price. So we actually think that now is the time to be concerned about inflation and reacceleration of reflation and being long assets that benefit from this. This is when we want to lean into that inflation trade. So maybe we're wrong though, right? So what's the interest rate market telling us? Oh, interest rates aren't going down as you expect in a deflation or disinflation environment. They're actually breaking out to the upside. So if you paid attention to interest rates over the last couple of weeks, you would have noticed that we've been saying, hey, we think this is going to go through 4%. And sure enough, we're at 4.24% right now. The 30-year mortgage rate is at 7.5%. Absolutely mind-boggling numbers when you think of the last 20 years. But the truth is, it's actually not that crazy from a historical standpoint. So if we look at the average 10-year yield going back to the 1930s by decade, I mean, 4.75%, if that's what we average over the next decade, not that crazy. I mean, we were right around that level in the 2000s, right? 4.4%. In the 90s, we're at 6.64%. In the 80s, we were at 10.6%. And in the 70s, we were at 7.5%. And in the 60s, we're at 4.7%. So we're just kind of returning to this normal environment where money isn't free. And believe it or not, that's actually good for the economy because it forces companies to actually invest in projects that have a high return on invested capital. So interest rates force a more productive use of capital. Now, longer term, as you know, if you've been paying attention to us, we think that there is this secular shift out of technology and into energy. Over the past couple of years, we saw this big outperformance for energy. Energy then pulled back relative to technology in the first 6 months of this year. We're now seeing inning number two. We believe you're seeing inning number two here as energy starts to outperform technology. Areas that we're focused on: global energy, metals and mining. Later on, we're going to focus on the banks. We're not buying banks right now, just to be clear. But if rates stay durably higher over time, that should permeate into bank earnings. And then lastly, consumer companies with pricing and branding power. If you're a commoditized consumer brand, inflation's not good, no bueno, right? You're going to get that margin compression. We also want to focus on cheap valuations, free cash flow rich companies, and those areas of the market that are underowned and maligned. So bottom line, ladies and gentlemen, stock market pullback looks pretty garden variety, looks pretty controlled and disciplined. So we would be buyers of pullbacks here. Energy does look attractive here. We can be wrong, of course, but it does look attractive. So we expect some additional but normal weakness as for the market as a whole, but pockets of strength in areas like energy and areas like consumer discretionary with pricing power and industrials. Technology remains a very, very big concern for us. So if you're very long tech and you see those stocks pulling back, don't let that affect your judgment as it relates to other areas of the market. Not all stocks are created equal. Okay, some stocks are expensive, some stocks are cheap. Let's go shopping for some of that cheap merchandise. Lastly, higher rates have sparked that initial move out of growth and into value. We think that's a durable move. We think that's a secular move. We think this is the start or the second inning of a shift away from high price tech and into some of these cheaper areas within energy and industrials and banks and consumer discretionary areas. So that's what we're focused on. 888-543-3776. If you have any questions or concerns, please feel free to reach out to your advisor. Otherwise, have a fantastic week. Thank you.